The Icons of Real Estate Podcast. Are you ready to learn the proven money-making secrets from top-producing icon agents? Ready to skyrocket your business? This podcast is for you. Tune in every week with your host, Tomasz Fonseca, and find out how to implement proven strategies to 10 times your business, from $3 million to $30 million in just 12 months. Brought to you by the Masters at Real Estate Marketing, Ardor SEO.
Welcome to the Icons of Real Estate podcast. I'm your host, Patty Teal. Today's guest is Lane Kawaoka. Lane owns thousands of apartment units across the U.S. He partners with investors who want to build their portfolio, but don't want to mess with the proverbial tenants mess, toilets, termites, all that sort of thing. His mission is to help hardworking professionals out of the rat race. Welcome.
Yeah, thanks for having me, Patty. Hello, everybody.
Yeah. Are you in Hawaii?
I am on the island of Oahu, Honolulu.
Lucky you. That must be so nice. So how we usually start the show, we have our guests kind of share their story. And I've read a little bit of yours, but I would love to hear it in person, how you got to where you are today, and how you got back to Hawaii. I know that was kind of a dream of yours. So just tell us a little about your journey into the world of real estate.
Yeah, so I kind of started on what I call this linear path that a lot of my clients are on, where we're all taught to go to school, study hard, go to college, work really hard there, get a job, maybe get a master's, maybe get a doctorate too. And then, go and work for the man and put your money into this 401k system and then these Roth IRAs and then buy a house to live in. And I call this that linear path again, so that's what I did. I went to school, studied hard. Apparently I was good at math and science. So I became an engineer and started to work as a construction supervisor. And I found myself traveling all across the country, and it wasn't very fun. It was, as most young professionals' jobs are, kind of the grunt work of the company and where a lot of the hard work gets done.
Mm-hmm.
So I saved my money. I was saving $50,000 to $100,000 of my paycheck every year, and I bought a house to live in, and realized that although it was kind of cool to have a house all to myself in my 20s, it just seemed a little inefficient. So I started to rent it out. This is well before the days of Turo, and that's where I got this taste of cash flow. And I was like, wow, my tenants paying down my mortgage. I'm getting the tax benefits. I'm getting this appreciation and, $400 or $500 extra a month from the cash flow. I better, if I could do this several more times, I could be able to quit the rat race. And that was kind of where it all began for me.
Wow. Well, that's a great beginning. And I hear that story very often from young professionals like yourself who really just decide they want to go for another direction where they can live their life freely and do what they want to do.
Yeah, and I think real estate is so powerful that you could buy one or two rentals and you could really change the complexion of your retirement. But I was still I think I was like 23, 24 at the time. I mean, I figure, well, just keep doing what I was doing, just keep saving 50 to 100 grand a year and just put it to more down payments. So, that first property I bought was 2009, and then in 2015, I had 11 of those dang things.
Oh my gosh.
I was doing a lot of those turnkey rentals. I first started in Seattle, which is more of a primary market like Hawaii or California, which, you're taught that, a lot of those places just don't have the cash flow. You don't have those rent to value ratios of 1% or higher to be able to, pay the mortgage effectively with a good leverage position. So in 2015, I had maybe 5 rentals in Atlanta, 4 in Birmingham, 1 in Indianapolis, and 1 in Pennsylvania. And I thought it was pretty cool, right? 11, who in their late 20s has 11 rentals and $3,000 of passive income a month, with a few $100 coming from each of them. And this is when I kind of try to pay for different masterminds and groups, because you go to the local real estate club and it's just a bunch of broke guys trying to fix up, flip houses and wholesale houses. not many people have full-time professional jobs buying turnkey rentals out of state, and not many people had more than a couple of them. So I had to pay to get into different high-level mastermind groups to get around other high net worth accredited investors. And this is where I discovered that, the wealthy do things very differently than the folks under $1 million run. And what they were doing was they were getting rid of their pain in the butt rental properties and going into syndications and private placements.
Mm-hmm. And did you decide that's what you wanted to do too right away, or did it take you some time? How'd that happen?
I fought it a long time, right? As many people who find a really good system, your ego starts to get wrapped up in it, and you start to religiously think that, man, my path to financial freedom is to get, I had like a dozen rentals at the time, a couple of dozen, then 4 dozen, then 5 dozen, right? And you're trying to do the math in your head. But, for those of you guys who don't have double digits in rentals yet, I'll tell you what happens. You're going to lose money on maybe a quarter of them or a third of them every single year. I had maybe 6 or 7 evictions in that short time span, and half of them ended up into huge repair bills of $10,000, $15,000 with the tenant trashing the house and just leaving it in shambles. And when you have that happen a couple times, so you're kind of like scratching your head. It's like, well, what are we doing this again for? Because it pulls you back. And just from a numbers perspective in terms of profits, and with 11 rentals, I maybe had eviction or 2 every year. It's just an exception rate that is going to happen, despite how you vet your tenants and what areas you buy in. It's just going to happen when you're dealing with Class B renters. And and you had maybe some kind of bigger issue that happened every quarter, which is all fine because I was using professional property management. I mean, how else am I going to do this when I work in my full-time engineering job? But
absolutely,
all this for $3,000 passive income a month. $3,000 is not enough.
no,
Most people,
not for all of that. No,
they need 10 or 20. So you need to multiply that number by 3. So now you're talking about an eviction every other month, and now some kind of big catastrophe every couple of weeks. And that's just not scalable. And now you combo that with, the people, these high net worth people are telling me that, yeah, man, you don't want to own rental properties. It's high liability. And they're right. But, if somebody trips or falls, it's your fault, and they're going to sue you. And they think you're the rich landlord. And then, the debt is all in your name. You get maxed out at 10 Fannie Mae, Freddie Mac loans in your name, and 10 Fannie Mac, Freddie loans in your spouse's name. If you're creative like that, to get 20. But it's just comes to a T where it's just not scalable, right? How does somebody with over $1 million net worth diversify their portfolio so they don't have more than 5% of their net worth into any one asset? And it's not with rental properties. I mean, it kind of is, but in a different format, where the ownership structure is where you're going in with a smaller group of people directly aligned with the operator, right? So instead of investing to the stock market where there's like 4 or 5 rungs of middlemen taking all your profits, we definitely don't want that. Those are retail investments, or like a REIT. I mean, that's what a REIT is. That's why I don't like REITs. I like the idea of it, but I don't like the org structure where there's all these middlemen taking your profits. But maybe a more lean down approach where there's a syndication or private placement, or other people know this as a country club deal, where you go into a deal as a passive investor, and there's a general partnership group, and it's a very lean management team operating the assets to the best of their ability, and they don't get paid unless you get paid as carried interest. Seems ideal. And I think that was where I was back in 2015. The concept made sense to me. It's just, where the heck do I find these people? Right. And this is where the whole idea of, especially when you become an accredited investor, it's all your network is your net worth. After all, you are the 5 people you hang out with most. If you're not hanging with accredited investors investing in these types of deals, you're not going to have access to them, and you're not going to start to learn about them.
So you started hanging out with these accredited investors and probably developed relationships with them, and that's how it kind of took off and grew into these deals with small groups where they're hands-on. I don't mean you're exactly hands-on, but they know what's going on.
Yeah. So, instead of like the mom and pop amateur little landlord buying,
Mm-hmm.
like myself, maybe buying a dozen properties or
Mm-hmm.
less, or even a couple dozen properties, you're working with, professional operators who this is their job, right?
Right.
They're not working their side accounting job on the side, operating a couple apartment buildings or, there's a lot of engineers in this business, that are still working their day job, right? But I'm talking, I would put my money with pure professionals doing this, who this is their sole occupation and
Mm-hmm.
focus is to
Right.
run these syndications the best of their ability. Um, but they don't have that big names, right? And there's many syndicators out there. It's really hard to determine, who to trust because after all, it is a fake it till you make it game. And a lot of the real estate gurus out there pretty much only teach how to brand and market themselves to make it look like they're
Sure.
legit
Yeah.
operators. And that was kind of what I discovered myself is like, it's really hard to determine what's crap and what's real out there
Yeah. Yeah.
in terms of vetting people. And what I kind of fell back to, and I would still believe today, is you have to rely on your own passive investor network because it's the people who's been invested with these guys in the past know really who's legit out there. And for a new passive investor, this can be very daunting. But if you start with building real relationships with other passive investors, adding value to them and building relationships, the shroud will be uncovered and you will
Mm-hmm.
find where to put your money and with whom to trust with.
Yeah. Well, wow, that's really some good advice. So I know that you have a mission to help regular folk to get good deals and help them through this maze that maybe were once only accessible to those who were very wealthy. So do you teach courses? Do you do mentoring? How does that work?
Yeah, I mean, a lot of this is kind of free on the website at simplepassivecashflow.com. And then the podcast, Simple Passive Cash Flow. What I realize is that, there's a lot of programs out there that, sell people on like a $30,000, $50,000 program. We live in the age of the internet and YouTube and, everything is out there for the taking, especially like my stuff. All my teachings and articles, videos, podcasts are out there on the internet for free. People can just go and grab them. It just depends what you're looking for, right? I mean, there's a lot of information out there for home flippers and wholesalers, but there wasn't very much information out there for working professionals who are busy. They have a decent amount of money, and maybe they are in their 40s and they spent a dozen or a couple dozen years blindly putting their money into a 401k because they just happened to get
Sure.
some kind of company match, right? There's
Mm-hmm.
a lot of people out there that these are like the shrinking middle class. This is what I was when I was an engineer, right?
Mm-hmm.
I mean, I don't want to say this facetiously, but we are the ones that kind of power society forward. We're the ones working our ass off. And
Mm-hmm.
we're also the ones paying all the taxes. It's not the wealthy people paying the taxes. And
Right.
that's another
That's
thing we
true.
educate people on is, how do you work with your CPA? What are the things? How do you use passive losses to lower your passive income? And potentially how to use rep status to lower your ordinary income, to drive your income down to zero. Right? That's what the wealthy do. And it's also not the poor people who pay taxes. It's kind of the shrinking middle class in the middle.
Mm-hmm.
And that's kind of been a big passion of mine. It's always the people who are working the hardest that deserve it the most that are kind of stuck working the 9 to 5 in jobs that may or may not like for 40 to 50 years. But what I realize, learning from these higher net worth folks is a lot of the secrets of the wealthy are very simple, yet they're very counterintuitive than what we're all taught. It's almost like there's some kind of system trying to keep us working forever, right?
Oh, maybe.
Who would think that, right? But to me, it's three simple things: invest in good deals where you don't get your money stolen by the operators, right? You're
Mhm.
vetting the people you're working with, and you don't need super high returns. But these deals are important because now you get the passive losses from these deals via cost segregations, bonus depreciation, or just regular accelerated depreciation. And you can use these passive losses as weapons to go and lower your taxes. And this is
Mhm.
where we play a different game in terms of tax. We're playing chess. Well, most people are screwing around playing checkers, 401ks, deferred
Right.
comp plans, like
Mhm.
that stuff works, but it just nothing compared to driving your income down to nothing,
Mhm.
or 200 grand or $300,000. We tell most of our clients keep it under $340,000 at the very least, and then we'll kind of work on it from there in subsequent years. But if you pay a lot less taxes, that's an ROI instantly that you
Mhm.
can use to go invest more. Thirdly is, we do a strategy called infinite banking where we overfund our whole life insurance.
Oh.
The life insurance needs to be set up in a special way. If not, yes, it is a scam per Dave Ramsey. But when you configure the whole life policy with very low insurance, which is very counterintuitive to most life insurance agents, it's a very powerful setup where you can kind of bank from yourself, take loans from your cash value policy, and then go invest in more real estate. And it's kind of a perpetual cycle. And these three simple strategies are very simple to execute. The thing is, well, who do you trust and the timing of it? But once you get it set up, and it's very simple, that's why, the URL is simple passive cash flow. It's very powerful when you combine all these three things. So, you take somebody who's $1.5 million net worth. They save, they're diligent savers saving 50 grand, 100 grand a year. Typically, a couple like that can be financially free at 4 to 7 years, no
Mhm.
problem. And when I mean
Mhm.
financially free, we're talking 5 figures of monthly passive cash flow.
Mhm. Wow. I hadn't heard about that life insurance with infinite banking. Of course, I knew people bought policies and borrowed from them, but I hadn't ever thought of it as a strategy for investing in real estate. So that's new to me. Very interesting.
Yeah, and a lot of this comes from the community that we have. I mean,
Mhm.
unfortunately, it's not coming from most CPAs, tax attorneys, because that's why they have jobs, right? No, don't get me wrong. The ones that we use, they're
Mhm.
good. They're
Right.
open-minded. But most people in the profession, they're more incentivized to do it the easy way for them.
Mhm. Mhm.
So I think that's where a lot of the good ideas, the cutting edge ideas, comes from your peer group, your community, and it's your choice of what community you want to have. Yeah, I mean, when people kind of find this stuff, I mean, it is definitely life changing. But I think we have a lot of problem, with people coming in. They're kind of brainwashed with investing in the 401k, the traditional assets, non-alternatives, and then they don't really, they're still trying to pay down their houses, right? So a lot of the common first steps for people is to, use HELOCs as a temporary source of capital to get this started and get proof of concept, and then, get a bigger refinance or maybe sell the house.
Mhm.
I personally don't feel like people should buy a house to live in until their net worth is 2 or 3 times greater than that house they're going to buy. So if you're looking
Wow,
to buy a
that's
$500,000
interesting.
house,
Yeah.
I don't think you should buy until your net worth is 1 or 1.5 million.
Can you explain why you think that?
Well, houses are not really that great of an investment. Sure, it's an appreciating asset, but your money is going to grow a lot more by maybe a factor of 3 or 5 investing in, real estate, right? Especially real estate rentals where you're doing value add or force appreciation to the asset. So like what we do in our large apartments is we go into, apartments that rent for like $700 to $1,400 a month rent. And
Mhm.
we'll go into properties where they're stabilized. So they're 90% occupied or greater and have good cash flow stream. But we target apartments where there is, older units.
Mhm.
Sometimes there'll be those yellow 1980s, 1990s type of appliances and the old flooring, the purple carpet.
Right.
We'll rip all that stuff out.
I see
We'll
it.
see it. When you pull away the bed, it's a different color, right?
Mhm.
But we'll change it out. Maybe pay 4 to 5 grand per unit and new flooring, new appliances, new paint job. Maybe put some playground equipment outside. We'll kick out the deadbeats in the community, the unsavory characters, and that's where tenants pay an extra 100 or couple $100 over time.
Mhm.
It takes a while, right? Because we don't kick out tenants. We kind of
Right.
let them naturally phase out. But by doing this, you force appreciate the asset. And no different than a house flipper flips a house at 6 months or to a year, apartment is kind of done in a similar manner. But the reason why I like commercial real estate than residential real estate is commercial real estate is based on numbers. if we can impact the bottom line, which is the income or expenses or net operating income in our world, the price that we get that we sell is based off the prevailing cap rate. So it's all numbers. Whereas residential real estate is based off all comparable sales or emotion. And it really is determined what the market is doing at that time.
Oh, I could see how commercial would be more predictable that way, and you would have a better idea of what's going to happen.
Right. And this is kind of why, the ability to do refinances through the project, pull out money tax-free. It's kind of all part of the business plan.
Yeah. So will you invest in all sorts of things? Mobile homes, I think I saw assisted living facilities, even, I don't know if you do storage units. Is it just all types of investments that you're involved in, just as long as they make a good profit?
Yeah, I think like my investment thesis, I want to invest in, red states where I, as the landlord or on the landlord side, have the laws on our side. We want to be in emerging markets where the population growth is going up due to job growth and other factors. And we also want to be in, the better locations. Other than that, I kind of target things that are what I call kind of catering towards workforce housing. I want things that if a recession comes, it performs maybe even better. Right. And this is why, like, you take the apartments, I like this B class type of clientele. I don't like the high end because I'm not going to hit my numbers buying that stuff. But in tough times, the A's move back to the B's move back to the C's in a way. And I like that whole thesis that, like, I want something that performs in a recession. And I think a lot of people are into the short-term rental idea, and you can make a lot of money doing that. But let's stop and think about it. That is a discretionary spending item. And in tough times, you are going to get absolutely cream investing in that type of stuff. A lot of the stuff I like to invest in are very boring, non-sexy things. And that's why our
but they make you money and they're safe. So that's a
right.
good thing. Yeah.
But it's a strange dichotomy we have in our investor group where, they don't invest in flashy things. It's kind of, there's a saying out there, money talks, but wealth whispers. And what I've learned is from a lot of wealthy people that are on the kind of the $1 billion plus net worth scale is the most boringest businesses are often the ones that you want to be holding on to, such as real estate or plumbing companies or, things like that. It's the commodity type of businesses that you want to be associated with, not these tech things, but for some reason, the kids, unsophisticated investors, or people who go after the flash, they like these like highly asymmetric plays or tech plays or VC startups. I get the appeal, right? It's cool.
It's exciting,
right?
Yeah.
If I wanted something like that, I go buy a restaurant or something,
Right.
But, as far as the majority of my portfolio, I feel like the best risk-adjusted returns are investing in stabilized assets that I can do a little sweat equity, force appreciate it, improve the community, bump the rents up incrementally, bump the income up incrementally, and just, kind of be okay when a recession comes and hold on to the asset with a good debt service coverage ratio. There's a lot more ways you can make a lot more money. But as far as, if a recession came or bad turbulent times came, I feel like I could sleep at night at the end of the day.
Right. So are you constantly on a daily basis looking for properties, emerging markets, as you mentioned? Are you just always on the lookout?
Yeah, I mean, we are always kind of looking for things. A lot of our deal flow comes from brokers because in our world, we're not going after pieces of junk. We're not going after distressed properties. The properties that we go after are stabilized. So the owners of them, especially in people think that you can send yellow letters to apartment owners. They're not idiots. They're not like some homeowner that owns a $50,000 piece of junk, right? These apartments are typically several $1 million. And unless you're working with their unsophisticated heir, with the owner dying, they're not going to fall for some stupid yellow letter and let me just sell you my property for pennies on the dollars. Especially if the property is stabilized and making money today, that's just not going to happen. So in our world, the brokers control these assets. they're the ones that actually do their job, unlike the residential world where they're going out and they're hunting and seeking deals. So in the commercial world, the brokers really earn their money, their commissions. So they're the ones really going out there doing, I think, what you're saying, the hunting for deals.
Right.
And they bring it back to us. And why us?
Mhm.
Because we have a proven track record. We've closed over 55, 60 deals, and they know that we can close. And that's really their biggest concern. They don't
Mhm.
care who can pay the most. They just care, who can close the transaction so that they can get their commission check and move on to the next sale.
And when you say they bring it back to us, is that pipeline club that I saw mentioned online? Is that where you work together with this group of people?
Yeah, that's our kind of in passive investor community.
I see.
But as far as like the brokers, that's more of our client facing side. We act more on the business side. As we have some other trade names too that we operate under. It's a little bit kind of like party in the front, business in the front in a way. But the brokers kind of just know us personally, and they bring deals to us as the general partners.
Well, that's great. Do you spend time helping to educate others? I know you said you have a podcast, so you do that. Are there other ways that you help?
Yeah, I mean, I would say a couple of years ago, I was really focused on helping, non-accredited investors. So we have a curriculum and program, people want to grab for free. How do you buy turnkey remote rentals? That's how I
Yeah.
got started. And
Mm-hmm.
I think like my heart kind of goes out to non-accredited investors. And it wasn't too much long ago that I was a non-accredited investor, right? What
Sure.
the heck do you do if you're not an accredited investor? You really can't get into these larger syndicated deals because you just don't have that much money.
Mm-hmm.
A syndicator would be crazy to kind of bring in a non-accredited investor into their deal, because typically non-accredited investors are kind of a pain in the butt to accommodate, because they freak out whenever one little thing happens, and they don't have that much money. And as far as referring their friends, they don't have accredited investor friends
I
typically. Go
understand.
figure.
Yeah.
But so I created this incubator program for them. So that's, there's maybe 20 hours of coaching calls for people. People kind of want to get access to that. They could kind of, join our group and then just shoot us the team an email. We can get you set up with that. But, part of this of wealth building, to get to accredited status and beyond takes time.
Sure.
I mean, real estate is, the good thing about it is it's very stable.
Mm-hmm.
The bad thing is it's not crazy asymmetric growth.
Right.
You're not going to get 30, 40, 50% returns a year plus like you can with some altcoins. You're also not going to lose 20% overnight, like the stock market.
Mm-hmm.
But, what I've realized is, these non-accredited investors, it takes a while for them to kind of step up to invest with us. And quite frankly, it's just not a really good use of my time. And, as an engineer and someone who's personally very lazy, or I call myself lazy,
I don't think you're lazy.
I record it, and there I don't have to do it anymore. So that kind of chapter has been closed. But, if people want to grab that education, they could, let us know. We'll give it to you guys for free.
Well, that's
But,
nice.
we focus more on the accredited investors these days, the curriculum with, how do you vet deals? How do you vet, look at the numbers, the taxes, what are things that best practice that we do? So you can take those ideas and have an educated, empowered conversation with your CPA. Or 95% of our clients have to leave their CPA at that point because they find that their CPA is just no good. And then, how do we set up their internet banking policies? And that's kind of our setup, our 1, 2, 3 punch that we kind of educate people on. We have a mastermind group of almost 100 people nowadays, because a lot of this is the currency of the wealthy is the relationships, and, people kind of doing this, thinking differently is very critical. Other than that, we've got the investor club, which is kind of open for the public. That's kind of how we accommodate people as best as we can.
And are you pretty much open to deals anywhere in the country as long as you think they're in an emerging market and that it will make a profit?
Yeah, sure. Sure.
Yeah.
It's not gonna be in California, probably,
Yeah.
say that
Yeah.
jokingly. We try and stay in the red states. Although we are doing things in New York City now, but there we're getting assets at a crazy evaluation because we have a relationship with the seller. So not saying that we won't go into a blue state, but unless the deal is really killer, right? And
Right.
we always count. I think investors, they kind of look at generalities, right? You know, Indianapolis is next to Illinois, which is getting a lot of people now, or, you know, this state has high or lower taxes. You know, it's all generalities, right? Like we kind of look at the deal specifically. What block is it on? What submarket it is in? And then what
Mhm.
MSA it's in. And then we also look at, well, what price are we getting it, right? Because
Mhm.
at some price, I guess I would buy something in Hawaii or California, but
Sure.
um, you know, I'm not holding my breath on that type of stuff. But
Gotcha. Yeah. Well, that's so fascinating. What would you say is your biggest challenge as an investor?
um, deciding when is enough enough. I think that's something for a lot of like
Right.
my investor group is, you know, many people they get to $4 or $5 million net
Mhm.
worth, or they're already on the path. You know, they're in their 50s and they're already to 2.5 million, and they they've already had a couple decades of adult life living at $8,000 to $1,000 of passive cash flow a month, or that's their spend rate. So
Mhm.
that's in theory how much passive income they need to sustain life and have it increase with inflation and not be worried about that. Um, it's what's hard is trying to figure out, and this is definitely first world problem. Woe is me, right? What is like my desired lifestyle? Distill that to a number. Is it $12,000 a month? Is it $20,000 a month?
Right.
And then build your portfolio to go out and achieve that.
And
Um,
everybody's different. We had a friend who was a billionaire and big into real estate, and it was never enough for him, but he just enjoyed the game of it. And then other people are going to want to do something else, travel the world, have some fun. So I think it's an individual choice.
yeah, and I'll say that, you know, I use this analogy times when we talk about this. Like it's like kind of like a bus or like the subway.
Mhm.
You know, everybody gets off at some point in the ride. Only the weirdos kind of stick on to the end. You
Well,
know, it's
that's true.
the weirdos being the billionaires, or you know,
Yes,
the people. Even
he was an odd guy.
some people think that, you know, $10 million. You know, once you hit 8 figures, that's enough. Some
Mhm.
people say 50 or 100, and you know, obviously, some people go off
Mhm.
to achieve billion plus.
Right.
I mean, it's really, I mean, for most people, $10,000 to $20,000 of passive income a month is enough. And to get
Mhm.
that, you just need to have $1 million or a couple $1 million in the game, making a measly 10%.
Mhm.
And especially when you're doing it with real estate, it's all tax free or should be tax free because
Yeah.
the losses are offsetting the passive income. But, you know, like, I think that's where you're exactly right. Like, people, they can go off to infinity if they wanted to, but we all know time here is on short, and you have to, it'd be a shame if you were just achieving and trying to keep going and, you know, your time ended.
Yeah.
I would say there's a part of this is to enjoy, which
Mhm.
is very opposite of, you know, personally where I kind of started. You know, you start off with this hustle culture, right? Read all these self-help books, and you get into this hustle culture mindset, and which is great when you're broke and you haven't done anything yet. But most of the clients that I work with are, you know, they're $1 million net worth or greater.
Mhm.
They're high performers, and they get addicted, or they feel like their persona is sort of tied to this hustle
Yes.
culture. I mean, they're all
Mhm.
type A individuals in their own
Right. Right.
rights.
Mhm.
But when do they take their foot off the gas pedal and start actually enjoying it? That's the
Right.
hard part.
That's interesting. Well, you're very wise and you make it all sound so easy. But I think you've got a good engineer's mind and you've been very analytical and you've done so very well. I appreciate all your advice and thank you for being on Icons of Real Estate.
Yeah, thanks for having me.
And how would people contact you if they wish to?
They can check out the podcast, Simple Passive Cash Flow, Passive Real Estate Investing,
Mhm.
or they can reach out via the website. They can fill out the club form, and they can book a call and get onboarded with us. They can go to simplepassivecashflow.com/club.
Thank you so very much. It's been great having you here.
Thanks.